Barry, you had a really good point about the consumer confidence data this morning. So don't focus so much on the headline read. Look at what's going on with the labor market, and you're seeing some cautionary signs there.
Yeah, I've got a very different perspective than Tom Barkin and most of the FOMC committee. I don't really understand why they're all that concerned about the near-term trajectory for inflation. I'm not in the camp that we're going back to 2, but if you think about the outlook for the next 6 months, we have that lag-impaired rent of shelter, housing-related measures that'll put downward pressure on the core. We had core goods prices go from a negative 1.6% annualized rate at the midpoint of last year to 0. But when you look at PPI measures of consumer goods, import prices, those will probably start putting downward pressure on goods prices. So I don't understand the concern about inflation, and I don't understand, say, Austin Goolsby's characterization of the labor market as in a stable, full employment environment. We've had turnover in the labor market absolutely collapse. When you look at the spread between job switchers and job stayers in the Atlanta Fed wage series, that's negative. That's very rare. That only happened during the depths of the global financial crisis.
Really?
And you have the spread between the lowest income quartile and highest income quartile also negative, something that happened a little bit in the early 2010s when the labor market was struggling with, household deleveraging, also negative, which implies demand for labor is really weak. So for me, the labor market's in a very precarious spot. I'm not saying that we shouldn't be diminishing or trying to reduce government employment. I absolutely believe we should. We had government employment growing 1% faster than the private sector and wages growing 1% faster than the private sector through much of last year, something that's only supposed to happen during recessions. But that could put downward pressure on the labor market as well. So the Fed's narrative that the labor market's fine and inflation's a problem, I think, is completely backwards. And so
you're bringing me all the little nuggets today. A lot of this, I feel like I want like the full notes, and we're gonna follow up on it to understand. You also point out, look, when you ask people about jobs plentiful versus jobs being scarce, that's starting to revert to pre-election trends. I mean, is that how you'd characterize it?
Yeah, I'm sorry I skipped that key point, which was your actual question. But no, that jobs labor differential conference board survey, it's very similar to the household survey, had a super tight correlation with the unemployment rate, particularly before the pandemic and distortions. But that points to a 4.3% unemployment rate. And we printed 4 last month. Now, last month's numbers in the BLS survey were completely distorted by their annual population change. There is a good chance that a week from Friday, we'll get a pop in the unemployment rate and the Fed's whole narrative will change. But we are moving in, to me, clearly to a period of weaker growth. I think it was you that was talking to Dave Zervos about this the other day. He and I have had a similar perspective on the balance sheet and the influence there.
Right.
I think we are headed towards weaker growth, and the markets are waking up to it. That's what is driving the 10-year rally, in my opinion.